Welcome to tonight's workshop. I do like to get started here right on time, a little introduction and things, and then we'll jump right in. So one of the things is that I do get a lot of questions regarding Social Security. It's not it's not that Social Security is that complicated. It's just that there's so much information that it doesn't get presented well. So we're going to try to do a good job, a clean job of letting you know about the Social Security benefits, some of the things to look out for. And some of the things you want to do, and obviously some of the things you don't want to do. So tonight is all about Social Security. For those of you that have been on some of my other workshops, whether it's retirement planning, income planning, all those kind of things, this is the specific workshop on Social Security and also Roth conversions, because the two kind of go hand in hand. And a little bit on tax. You can't talk about maximizing one thing without talking about minimizing your taxes. So lots of changes. Certainly, if you've been watching the news, lots of changes, whether it's taxes or Social Security or any of these other kind of benefits. 51% say we're on a good track, 49% say we're not, and that's kind of where it's at today. So anyhow, we're not going to talk about politics today. We're just going to talk about Social Security. So you are in the right spot if we're going to talk about Social Security and how to lower your taxes. One disclosure here first is that I am a fiduciary, registered investment advisor. I'm going to talk about some of the market, some of the things to look out for. I do not work for the Social Security Administration, and also I am not a CPA, and I'm not an attorney either. So I'll stick to my wheelhouse, which is investments and Social Security for tonight. So everybody signed up for this, just so everybody's on the same page. You get this Social Security workbook for free. You signed up for our workshop. This is part of your benefit. In about 50 minutes, you're going to get a link on your cell phone, the cell phone number that you gave us when you signed up for this class. On that link, you are going to be able to download your workbook. All right. So don't worry, you'll be able to download it. It is yours. It is free. And really, at this point, you have two options. You have one option where you could download the workbook and go through it on your own, right? What this workbook does is it tells you how to maximize your Social Security. So sometimes you'll have to coordinate if you're married or if you've got a spouse or been married, things like that, divorced. You'll have to coordinate some benefits, but you can do it on your own. That's what this workbook was incorporated to do. And option two is that my staff and myself can give you the reports that show you kind of what if scenarios, right? What if you started at 62? What if you waited 66? What if your wife started? What if you started early and you held off? So these are some of the things that we will do for you. My staff and I will do the heavy lifting, and we've done hundreds of these. So you really have two options, and I'll show you how to get our staff to do it for you if you want. And also everybody though will get the workbook. So I've had a couple questions about that already. So everybody that's on this call, and by the way, if you're watching this on a rebroadcast, I do send this out to everybody that had signed up for the workshop. So you don't have to take notes. That's the other thing. You don't have to take notes tonight. You can always go back and rewatch it. If you do want to take notes, that's fine, but you will have the option to go back and view this again. So why is Social Security such a hot topic? Every day 12,000 baby boomers turn 65. Now that is a lot of folks. 3.6 million people per year, every year for the next 10 years are going to start taking Social Security. So what that does is that because there are so many people starting to take Social Security, it has drained the fund, right? We'll talk a little bit about the dynamics of how Social Security works, but just suffice it to say is that there are more people taking out than there are people putting in, and therefore the balance is getting lower every single year. All right. Now, what does Social Security mean for you? You should really think of Social Security as an insurance policy for longevity, and that's really what it's used for. So one of the benefits of Social Security is once you start getting it, your benefit only increases with the cost of living increase over time, but you get it for life. It's one of these few and rare benefits that you're going to get for life. Social Security, Medicare, and when you retire, those are the three biggest decisions that you'll have to face as you get ready to retire. And 65% of middle income Americans, just 65% of most people that you would know, get more than half of their income from Social Security. So that's a lot. You figure if Social Security on average is about $1,700, $1,700, 65% of folks are getting more than half of $1,700 a month, right? That's a lot of folks relying on very little money, but it is there for life. And since 1985, corporations basically got away from it. What you used to, if you work for AT&T or any of the big companies, IBM, you would get a pension when you retired. No longer, there's very few companies out there that get pensions. Just from this statistic from CNN, 84,000 people or 84,000 companies have really gotten rid of their pension plans. So whether they replace them with the 401k plans. So if you're working and you're getting a 401k plan, chances are at one point your company probably had a pension plan if it's a larger company, certainly S&P 500. All right, so some of the questions to ask yourself is that, do you insure your home, your car, your health? Do you insure your retirement? Again, think of Social Security as the number one thing to help you through retirement and make sure that you don't run out of money. All right. How long will you live? I like doing this. Unfortunately, every once in a while, I got to change the slide. But this lady, she is Japanese. She is 116 years old. I throw this in here just to show you that if you're going to live to be 116, you should have maximized your Social Security benefit. Certainly, she would have worked out and got a lot more money out of Social Security if you're 116. But since she's the oldest living person and Elon Musk found people that are 130, who knows? Who knows? Maybe they're hiding in the woodwork. Anyhow, don't post any negative stuff. Okay, so our focus today are really the ground rules for benefits on Social Security. There are some caveats to the rules, so it's good to be aware of those. Strategies for obviously married couples, divorce, and widower benefits. And that's really a special category. If you're a widow or a widower, that's a special category. You do get allowed a few extra perks, and we'll make sure that we cover that for you. And obviously, to tie it all together is taxes. We want to pay as little as possible on your Social Security benefit, and I'll explain why. Well, you want to pay minimum amount on taxes at any time, but I'll show you why you want to do minimum amount on your Social Security, because it can bump you up in tax bands depending on what tax rate you are when you retire. All right. So some of the basics of Social Security. How do you qualify? Social Security, basically you had to work in a job that Social Security covered. In other words, you got to be paying into Social Security. So you need 40 credits. You say, well, what is a credit? And it's really about 10 years worth of work. And it's for, excuse me, each quarter that you earn $1,500 or more is one credit, and you need 40 credits. So by and large, if you're working even for minimum wage now, and you're working 40 hours, you're going to be over the $1,500. So it is important to know that you will not qualify unless you hit the 40 credits. I've had people call me and say, hey, I've got 39 credits, or I've worked 9 years, or they've worked 12 years, but some of them didn't count because they were business owners. And by the way, I'll talk a little bit about business owners here in a minute, but you need to earn that amount. Okay. For those of you who are doing real estate, you're kicking butt, but you need to be paying yourself a salary and paying into Social Security, because you will cut yourself short on this. And don't think it can't happen to you, because I've just talked to 2 people in this past week that it has happened to. So if you are real estate and you're kicking butt, or you're a business owner and you're not paying yourself, income where you're paying Social Security and FICA and the rest, you need to start doing it. All right. This isn't business owner class, but I just this keeps popping up. So I want you to understand that you need to have 40 credits. And it's also the highest 35 years. So let's say you've worked 30 years, 5 years you have not worked. Well, it's going to take an average of the 35 years. If you've got 5 years there where you haven't worked, they are zeros. You may have qualified for it because you hit the 40 credits or 10 years, but you are posting zeros. So if you do a straight average, and by the way, it's weighted for inflation. So in 1980, just so you know how it's weighted, in 1980, it's basically 4-1. So if you earn $20,000 in 1980, it's the equivalent of earning roughly $80,000 today. So that's how they do weight it. And it is adjusted for inflation. But again, going back to this 35-year history, is that if you've only worked 30 years, and normally how this works is we typically see it if there's a stay-at-home mom or wife, or however you want to do it. One of the people of the family stays home. You're not getting any earned income over those years. So there might be 10, 15, even 20 years where they're just zeros. So you'll have to account for that. You may have to get spousal benefit, and we'll talk about it, spousal benefit. But my whole point of bringing all this stuff together, we're going to do a really high level. All right, we're going to do like 30,000 feet. I'm going to give you a lot of little tips and nuances and things. But I think as you go through here, you'll see that it's probably best to have somebody kind of put this together for you, because it's a big jigsaw puzzle. There's big pieces. There's just a lot of pieces. All right. It's not hard to put together. It's just a lot of pieces. And exclusions or reductions. Actually, I should probably pull this out of here, because now the government pension offset and the windfall elimination provisions, the government workers, they did away with that. So there are 3 million more people that are taking maximum Social Security that had it reduced before. And you figure if there's 3 million more people taking Social Security, guess what? It's draining it even faster. And we'll get into the numbers, but anytime you have more and more people, or you're adding people to it, then you are reducing the pool for everybody else, right? So how does Social Security work? Pretty simple. You're putting money into a big pile, and people are taking money out, right? That's the ground rule. That's basics. You yourself, if you're not self-employed, remember, we're self-employed. It's kind of a separate little thing that I'll touch on, but not a lot. If you're working, you're paying 6.2% of your salary into Social Security, but there is a cap. Okay. So in 2025, if you earn over $176,000, you no longer are paying into Social Security. So that's important to know. So if you're making $250,000 or $300,000, you have a cap that you're paying into it. Again, for 2025, it's $176,000. Now, your employer matches the 6.2%. So in total, it's 12.4%. So you're paying 6.2, your employer's paying 6.2. That money goes into the Social Security system. And then everybody that is currently getting Social Security is pulling that money back out. Right? It's not going into a fund for you like a 401k, and you have a balance. You do not have a balance in the Social Security Administration. They know how much money you've paid in. They do know that, and you can get that if you log into socialsecurity.gov or ssa.gov. But you do not have that money accumulating for you over time. Right? Had they have done that, it would have been very solvent. It would have had tons of money in it, and it would never have been a problem. But when they first put it together, that's not how that worked. Right? And today's contribution covers today's benefits. That's what I was saying, is that if you are putting money into Social Security, which if you're working, you are, everybody that's collecting Social Security is taking your money out. All right. This is the only one time where the pyramid scheme is legal. And the only reason why it's legal is because the government's doing it, not you and me. All right. All right. So what about solvency? This is a big issue that comes up all the time. When I do my financial plans for folks, a lot, I wouldn't say a lot, maybe 15, 20% think that they should start getting Social Security immediately. As soon as they turn 62, they should start pulling money out because they think it's going to go bankrupt. It won't go bankrupt. All right. We're going to talk about this. But if you're thinking, hey, I need to start at 62 because there's not going to be any money in there for me when you get older, that's not the case. That's not going to be the case. All right. So I'll explain why here with some numbers, but don't think of it that way because you could end up hurting yourself in the long run. Okay. So 2010, it was in the red. There are 70 million recipients. I forget when I pulled this up. I think it's this press release in 2024, so I don't know the specific numbers here for 2025. Remember, now there's 3 million more that are starting to get it too because of the windfall elimination provision or the government workers. But anyway, 70 million recipients. It is funded through 2035. I would say that that number will probably go down to 2032. It comes down, it creeps down year after year because more and more people start taking money out. And that assumes that we are at full employment. Remember now, if we ever have any dips and ebbs and flows in the business cycle and people start getting laid off, they're not paying into Social Security. And this is always kind of a best case scenario. So 2035, best case scenario. And then 2036, there's 83 cents on the dollar. So in theory, if they paid you only what they had in the coffers, then your $1,000 a month Social Security would drop to 830. Again, this is probably not what's going to happen. It could though. It could very well happen. But there's 4 basic proposals to improve the solvency, and they've been kicking these around. I would say by the end of the year, they're going to have some sort of not 100% fix, but I would assume that they're going to have some fixes in place to potentially push this back up to 2040, 2045. I don't know that for a fact, but that's just the feeling that I have. Everybody knows that as of now, you can start getting Social Security at age 62. They may increase that to 64, 65. Increase the full retirement age. It used to be 65. They increased it to now it's 67. It could be 68. So we're not sure about that. They could increase the payroll tax. And typically they're not going to increase the amount that you and I are paying into it, but they may increase the employer's 6.2% to 7.2, 8, 9. Who knows? Because they don't see that, and you won't see that in your paycheck. So they always try to sneak these kind of things. They're very sneaky into the back end of the equation and have the employers pay, right? The employers always have deep pockets. I'm just joking. Employers don't always have deep pockets. Sometimes they do, sometimes they don't. And they could reduce your benefit, right? Typically, they're not going to do that. You and I vote. Hopefully you vote. Normally people that are in the 60-year-old bracket vote. And certainly if you vote, politicians know better than to tinker around with that. So how are your benefits determined? This is just easy, straight line. I did it for folks that turn 66, not 67, only because it's a little easier to look at. But if you retire early, you're essentially taking a 25% pay decrease. All right. So if you go out at 62, you get 75% of your primary benefit. And your primary benefit is calculated at your full retirement age. I'm throwing a couple of acronyms at you. But in this example, it is 66. But by and large, most people here watching this is 67. But nonetheless, you get about a 25% reduction in the amount you get. This is where the strategies come in. You say, well, I don't want to get 25%. That's fine. We can show you how we work around it. And then if you wait to age 70, you get 132%. So let's say that this is $1,000 a month at 66. You can go from $750 a month up to $1,320 a month. All right. Excuse me. I had to clear my throat. So as you can see, it goes up roughly 8%. Now, it's not a true 8% per year. It's 8% divided by months because every month you wait, you get roughly 0.8%. It's not 8 well, it is 8% for the year, but it's 0.8 roughly every month. So every month you wait, you get a little bit more. So there are 3 distinct benefits. First benefit is your own benefit. Okay. So if you've paid in there, you've got the 40 credits, you've accumulated your money, you've paid in the Social Security, and there is a benefit that you get for filing on your own. Okay. If you want to find out what this is, you go to ssa.gov, ssa.gov. For those of you who have not done this, ssa.gov. You can go in there, create a login if you haven't already. It is very difficult login. It's probably not something you remembered, so hopefully you wrote it down, but you could reset it. SSA.gov will tell you your benefit amount, though. And I don't know how to erase that. Anyhow, spousal benefit. Here I done marked up my little board. Spousal benefit, and it is the benefit you get from your spouse. All right. Typically, you can get 50%. There are some nuances to that, but typically you can get 50% of your spouse's benefit once they claim. Remember that once they claim, because you cannot get 50% of a spouse's benefit until they do claim. Right? And widow or widower benefit. This is the third benefit, and it provides the surviving spouse with a benefit after the worker's death. Right? So we'll go into a little bit more detail. Filing. Actually, you know what? Let me go ahead and try to erase that. So let's go over to the eraser. There we go. All right. I knew we'd figure it out. All right. Filing. Now, if you go to file, remember that I said this is one of the two biggest decisions you'll make when you go to retire. The only reason being is that once you decide to go ahead and start your Social Security benefits, out of the hundreds of people that we've helped do this, nobody has rescinded it. All right. You can rescind it in 365 days. In other words, if you say, hey, I'm going to file for Social Security, we had a client actually receive a large inheritance and he tried to rescind it, but it was during COVID, and it was taking him so much time and energy that he just went ahead and collected. But that's really the only time you would want. If you started it, let's say that you started it, you decided to retire, you got bored, somebody gave you a big job, you're making $200,000 a year, you would want to go in and file and rescind it. Now you do have to pay the money back, but you have 365 days in order to pay it back and restart. You can restart your benefit at the higher amount. All right. So there is a way to do it, and you can do it. I just don't see it being very popular. So if you're a married couple, you have to be married for at least 1 year. So these are the rules. All right. So if you're married, this is kind of the slide you want to pay attention to. So spousal benefits, you have to be married for at least 1 year. The primary worker must have filed. Again, I see this a lot happening. And oh, sorry, I got it on the eraser. This part right here. The primary worker must have filed. You can't get the benefit without it. And you do not qualify for a benefit on your own. In other words, on the third bullet point here is that if you qualify for more than your spouse, you don't file for your spouse's benefit. You get your own benefit because it's going to be higher, and they don't allow you to file and suspend anymore. So you would go ahead and file, but you would get your own benefit, not your spouse's. And you get up to 50% of your spouse's PIA. Remember a couple of slides ago, I said at full retirement age, it showed the 100. And for that example, we said it was 1,000. Let's suppose John waited and now he's getting 1,320. You are only getting 50% of the 1,000. You will not get 50% of his higher benefit. Okay. So this is a big thing that people miss. So you only get 50% of the primary insured amount, not the benefit of the spouse. So this is important. It's important to know that. And I'll demonstrate that here in 1 second. So a quick little example, John is getting $2,000 a month. Jane would get 1,000, right? Super simple. This is where I want to show you. So if John had filed early, remember, if John files early, he gets a 25% reduction. But not only does he get a 25% reduction, but the spouse gets a 30% reduction. So not only if John files early does he get penalized, but the spouse gets penalized likewise. Important to know. A lot of folks miss this. So when you're doing planning, make sure that if you are married and you're going to get spousal, that you are asking the right questions. Okay. Again, I talked about this, but this illustrates. So if the spouse waits and now they're getting 132%, remember the spouse only gets 100% of this amount at age 66. Okay. Now, survivor's benefits, this is pretty simple. One of the spouses is going to pass away, and then you get the maximum benefit. Again, you're going to get the maximum benefit. You know, they're not going to penalize you because your spouse has passed. So you get your own benefit if it's higher, the benefit of the deceased if it's higher, and 82.5% of the deceased if they filed early. The Social Security Administration penalizes everybody across the board if you file early. It's important to know. So some of the most common mistakes is that the higher wage earner files early. You don't necessarily want to do this because you're shortchanging the survivor benefit. And both delay past full retirement age and no one claims a spousal benefit. Whenever we run these, especially when we're looking at spousal, it's interesting, but the bottom line here is if the husband and wife are about the same age and in the same shape, right? As far as longevity, you don't have any ailments or things like that. Typically, what you want to do is you want to have the male wait, and you would want to have the female go ahead and file early. This is if you needed the money. The reason being, males don't live as long as females, and you want to maximize the amount. So if the male waits and now it's at a higher amount and he passes away, now the female or the spouse now gets his benefit and he waited, so now his benefit is higher and now the wife gets the higher benefit. Okay. So that's one little strategy tip that I'll just share with you. It's super important though. Remember, you got to coordinate this. Once you start it, if you start it wrong, then it's hard to go back and fix. All right. So you want to just spend a little time. I appreciate everybody being on the call. It is a little tricky, but not too tricky. You just need to know the rules. Just like driving. You got to know the rules before you give 18-year-old keys to the car and tell them to go out on the road. So if you are divorced, you need to be married for at least 10 years. You could be married to more than one person for 10 years. You could, in theory, be married if you're 65 years old to 4 or 5 different people for 10 years or more. Don't really see it too often, but you could. And you cannot currently be married. So if you're married, divorced, and got remarried, you negate your divorced benefits. And same benefits amount. What the next point is that the same benefits apply to if you were married. So if the spouse applied early and is getting a decreased amount, you would be getting a decreased amount as well. And if the spouse waited, you only get the primary insurance amount, all right, not the higher amount. And independently entitled for divorce for 2+ years. So that means that you can't just get divorced, run down the Social Security Administration and say, I want to get my divorce benefits. You've got to wait 2 years. You got to be divorced, can't get remarried, and you got to wait 2 years. Those are the basic 3 rules that commonly get overlooked. And some of the questions that we get, the main question, I tell you, the main question we always get is my divorce partner going to find out that I am applying for benefits based on their benefit? And the answer is no. First off, it's your benefit, not their benefit. The amount you get paid is based on their benefit, but in no way impedes on how much money they get. So don't worry about that. That's the single biggest question I always get. They are not notified by Social Security that the ex-spouse is applying, or somehow they're whittled their way into the money. The ex-spouse cannot stop you from getting their benefit as well. So that's one of the issues. All right, so if you're widow, whatever benefits, if you are, this is the section for you, because there are a couple special things that you're allowed to do that nobody else is. All right. Some of the qualifications, first thing is you got to be a widow or widower. Here's one that you can be 60 years old and apply for widow benefits. All right. You do not have to be 62 years old. So you can apply early. I'll show you where this comes into play, but you can apply early and qualify for Social Security. And unmarried. So you cannot be married before age 60. At age 60 and 1 day, you can go get remarried and you do get your benefit, but you do have to wait until you are past 60 years old to get your benefit. And you have to be married for at least 9 months. This is kind of a special provision. There's always people that try to figure out loopholes of these kind of things. So let's say that somebody is dying of cancer and they want to give their friend their benefit. So you're dying of cancer. She reaches out, says, John, you know what? Why don't we just get married? That way you can get my higher benefit. I'll help you. You can help me. They will disallow that. So it has to be 9 months. And by the way, there are special exceptions. If you got a married couple, one gets shipped off to Iraq or what have you, they get killed in action or there are exceptions. You just apply for the exception, tell them what happened. If it's unforeseen, they're probably going to give you a waiver. If it was something that you knew was coming down the road, like cancer or something like that, they probably are going to disallow it. Right. So here's a quick little example. You got Jane here and John. John died at age 64. And his benefit would have been 2,150. Jane was 5 years younger, so she was 59 when he died. She remained unmarried. Remember, I said this is one of the rules to it, is you have to remain unmarried. And Jane's estimated benefit on her own at 62 was 1,197. So, somebody comes to me and says, Terry, I've got a kind of a unique situation here. I need to figure out how can I maximize my benefit. All right. And I'll walk you through the process here. So first things first, strategy number one, we say, okay, we already know that you can file for widow benefits. You can do it at age 60. Remember, so a couple of different things. You're going to see where you can start it at age 60 or 62. And the variations are whether or not you get widower benefits, you get John's benefit, or you get your own. Okay. So that's the difference here. So you started at age 60. It's $1,537 a month. So lifetime benefit gets you $461,000. All right. So this is the lifetime benefit. We're going to assume that she's going to live to age 85. All right. Strategy number two is you file for retirement at age 62. So it's 2 years later. You file for your own benefit, which her benefit, Jane's benefit, was $1,197, close to $1,200. And at age 67, she switches to the widower benefits and she gets 2,150. So you can see here the numbers add up to 538,000, which is about $70,000 more. So that's nice. You get $70,000 more out of Social Security just by a little switch. Now you would have to wait until 62. But there's one final option as well. So, okay. So you get a 17% increase in that. And you could file for widow benefits at age 60. Remember, you get a special election for widow and widowers. You can file at age 60. You get 1,537. And then you can switch over at age 70 and start collecting on your own benefit and get $2,108. So how does that add up? You can see it's $563,000. So it's a 22% increase. So let me ask you, would you like to get 461,000 or would you like 563,000 out of Social Security when you retire. Everybody here, I'm sure, would say, you know what? I get to get the benefit early because you're getting it at age 70, and you also get an increase of 22%, about $100,000 more out of Social Security. Again, this is what we would do for you if you come see us, or you can do for yourself on the workbook. You just need to know how to plug in the numbers. All right. So can you still work and collect in 2025? The answer is yes. I just had a lady today, very nice lady, very nice lady. She works for one of the school districts that I work with. And she's like, well, I've never filed. She's almost 70 years old. She'll be 70 this year. She's like, I didn't want to file for Social Security, even though she could have used the money, because Social Security takes the money back. Couple of things that are not correct with that statement. First off, once you hit full retirement age, doesn't matter how much money you make, you do not get a reduction in your Social Security. Now, you will have to pay a lot in taxes, but you do not get your Social Security reduced. Social Security reduction comes in if you retire at age 62, you are still having income over $23,000. So you're allowed some income, but not a lot, or anything over $23,000. They start reaching into your pocket and pulling that money back. And the way it works is you just don't get paid until you've paid the government back their amount. And once you've paid back the amount that they carve out, you start getting checks again. So you may go 2, 3, 8, 9 months until you start getting a check. All right. They don't prorate the checks. They just don't pay you for months. So if you're thinking that they prorate it and you're going to get a little bit of something, you're going to get a lot of nothing until you pay it back, and then they will start your checks. So just keep that in mind. A lot of people don't know about that, but that's absolutely how it works. And it's $1 for every $2 over. So if you're working, you make $40,000 over the limit, they're going to take $20,000 back. So at that point, they're going to take almost all of your Social Security back. It doesn't make sense to do that. So if you're making $65,000 or more in this year, to 2025, if you're making $65,000, don't apply for Social Security early. You're just simply wasting your Social Security benefit for two reasons. One is that they're going to take all of it back, most of it. And two, you're not going to get the 8% increase in the years that you could have by waiting. Super important not to do that. Do not cut yourself short in Social Security. All right, so Social Security does get taxed. The government comes out with this lovely publication, 915, talks all about the ways Social Security is going to get taxed. I'm not going to get too far into this now because the way it looks now, they may not tax Social Security. Now, I don't know if they're going to get that passed this year. I know they're fighting hard to decrease the budget, but I don't know if they're going to be able to, decrease it and offset this. Obviously, they need to have offsets. They can't just stop taxing Social Security if they don't have any offsets, at least not at this point. So this is the way it looks today. It's all about provisional income. Again, if you want me to get further into this, feel free to set up a time and you can meet with us. That we do have strategies to help lower the taxes. Assuming that they are here, we can absolutely show you the strategies that are available today. But it's called provisional income. You add up the amount that you got in Social Security, which is line 1. You take half of that, which is 12,000. And in this example, we're going to say that you earn $30,000 worth of pension benefits. It could be earned income, CDs, whatever the case is. You're going to earn another 30. So $42,000 is what this person earned. Again, 30,000 came from just earned income. Remember that 42,000. If you are single, then 42 is below here, which means 85% of your Social Security is taxable. 15% is not taxable. and 42 falls in here if you're married. So 50% of your Social Security gets taxed. 50% is tax-free for you if you're married, right? That's really what provisional income works, or how it works. Now, there are a couple different things that types of income that do not affect your provisional income. First off, are Roth distributions. I'm sure at this point, most of you that are nearing retirement have looked at Roth IRAs and said, they kind of look good, they kind of look bad. As a general rule of thumb, if you have not put together a Roth IRA, please go to your bank, take $100 out of your bank account, open a Roth IRA. The reason being is that there is a 5-year window that you need to have a Roth IRA, 5-year window. And after the end of the 5 years, the interest it accrues is tax-free. Okay. So you always can take out the money that you put in because you've already paid tax on it. But the interest that it has accrued is now tax-free. And so you want to have that 5-year window start, right? That's just a little side information thing. But Roth distributions, if you have cash value life insurance, you can get a loan out of this. This again is another one of the loopholes that is available for tax planning purposes. We have a lot of clients that have used these. And basically you're putting money into a life insurance policy. It allows you to borrow money out and not have to pay taxes because it's a loan. And the one thing that does are municipal bonds. So if you are a municipal bond person that has a lot of municipal bonds, the interest does go against you for Social Security reasons. Again, I don't set the rules, but municipal bonds does count against you. All right. So filing early versus waiting. So we're going to do a quick example here. I want to just show you what does it look like if you've got a couple that are thinking about this, they're in their early 60s, and they're saying, you know what, we're not sure whether we should wait to file Social Security or should we file early. Okay. So this is just an example of if you waited versus filing early, what does it look like? Does it make sense to do it? Or does everything pan out and look exactly the same? So we got a married couple, $34,000 in combined Social Security benefit that they file early, okay, at age 62. Starting retirement with $750,000 in 401k and IRA assets, 352,000 that they have saved, 401ks and IRAs. We're going to assume that the market's going to grow, or whatever investment they're using is going to grow by 6%. And there is a 3% inflation. I'll show you the inflation here in a second. They need to start with $70,000 a year in inflation adjusted after tax income. So this is just filling out retirement needs for when you retire. And we're going to assume that one of them's going to live to age 86 and the other one's going to live to age 89. All right. So that's fine. That's what they need. Those are the rules. We say, okay, well, let's just chart this out. So the blue line is the Social Security payment that this couple is going to receive. The orange is how much money they're taking out of their 401ks and IRA. Remember the 750,000, that's where this orange line's coming in. The red line is $70,000, adjusted 3% every year that they wait. As you can see, the slope comes up. The orange above the line are taxes. Everybody's going to have to pay taxes. So that's where it goes. And you'll notice here that they get about 23 years into retirement. They're both still alive. But all of a sudden, this orange line disappears. What happens? Well, to be honest with you, this couple runs out of money 24 years into retirement. This is where they're calling their kids saying, hey, mom and dad need a place to stay. Can we come live with you? They didn't necessarily run out of money because Social Security is still paying them. However, Social Security is paying them about, $65,000 here. but they need $120,000 or $125,000 to live. So they're not completely broke. Remember how we started this whole conversation is Social Security is a kind of a safety net or a life preserver for you. This is why we say that, because you don't run out of Social Security, but you do run out of income. So this is if they retired early. So let's take the same example and let's see if if anything has changed if they filed later. So you see, okay, well, you'll notice that these orange lines are considerably bigger in the first 8 years of retirement. Basically, they still need $70,000 to live, right? You still need $70,000 to live. But what's happening here is that most or all of the money that you're needing to live off of is coming from your investments, right? That's what the orange line was. And again, the orange above the red line is taxes. So they are paying taxes. They are taking money out. They've waited. And now you see, well, at 23 and 24, this is where they ran out of money on the prior example. But if they waited for the Social Security, you notice that they never really ran out of money except here at year 34. And this is where one of the partners has passed away. So they were able to get a lot more money out. And the reason being is they got Social Security or they waited for it. You say, well, that all looks fine and good in a graph, but does that make sense for me or does that make sense for what we're trying to do? Here's the numbers. All right. So they get $186,000 more by waiting or 30% additional Social Security. Again, I asked everybody if you could get 30% more, how would you do it? Or would you want to do it? Most of you would say yes if we're in a classroom. $186,000 you get more. 14 more years of income. That's important. You don't want to run out at 23 years into retirement. You want to make sure your income is going to last you a lifetime. So you really need that to work in your favor. And now here's one that you may not have thought about, but because we've stretched it out, you're actually paying $35,000 less in taxes because you started your Social Security later and you got 14 more years of additional income. So all things considered, would you want to start your Social Security if you're this married couple, if you and your partner, would you want to start early or would you want to wait? Hopefully everybody said they would want to wait because it's really important to make sure that you don't run out of money in retirement. So a couple things about your statement. And it's almost coming up on the 50 minutes past the hour, which everybody's going to get their texts. So I'll stop here in just a minute and explain what you're going to get on your phone. Again, if you are watching this as a replay, I'll leave the link at the end of this workshop so you can get your or download your workbook as well. So about your statement, everybody used to get that statement in the mail from the Social Security Administration. You now don't get them in the mail, or some people don't get them in the mail. You have to log in. Again, it's ssa.gov. A couple of things about your statement, though. There are no cost of living increases applied to your statement. So if you're looking at it and you're 62 years old and you're looking at your benefit at age 70, that does not account for the 8 years of cost of living increase, which is roughly 2.5%. All right. So it's overestimating or understating. Sorry. It's understating the amount that you would get. And it also assumes you're going to work until that age at your current rate of pay. So if you're looking at it, you're 62 years old, you go, well, I'm going to get mine at 67. It's going to assume that whatever amount you made last year, you're going to make for the next 5 years. So if you retire early at 62 and you wait to 67, it is overrepresenting what you're going to get. There are no cost of living increases, but whatever you're getting today, it's going to assume that going forward for the next 5 years. So that is not good. And it also only does your record. Again, Social Security Administration is very tight-lipped about giving information about your spouse, especially if they're still alive and you're married and divorced and all that kind of fun stuff. If you and your husband or wife are on the phone, they don't have too much of an issue. But if you are not, they don't. Here's the thing about Social Security Administration. They do not want to give you wrong advice. So they've been essentially told not to give you any advice. But then again, you need advice to figure out what your benefit is, right? So a couple of things. One is that you just did receive the text if you are watching this live. You can go ahead and after this is done, you click on the link and you can download your workbook. Super, super simple. Again, everybody gets that. And there's no advice if you're looking at your statement as well. Again, it's not hard. If you want to spend 10 minutes with us and try to figure out the best way to get your Social Security to maximize it, we're more than happy to do that. That's what we do. We've been helping hundreds and hundreds of people do that throughout the years. The Roth rollout strategy, or Roth IRAs. So this is if you're a married couple. I got to caveat this and just say this is hypothetical, but in all honesty, this is kind of what I had talked to somebody, and this is the numbers they gave me. But it's important to know that if you have a lot of money, or if you have over $250,000 in IRAs, it may benefit you to do Roth conversions. And I say may because I can't guarantee everybody would benefit from the strategy. But this just looks at what would happen if you did a Roth conversion. And baseline, we want to just say, well, does it make sense? I mean, and I'll show you how this one does make sense. But had a married couple, both were government workers. They did not need investment income. They had about a 1.3 million they had saved in 457s. I think his was a 403B. Anyhow, government workers, not 401ks, but very similar because they are with the government. And so I run this, and this just shows you an example of how much they would have to write checks out to the IRS if they did not take any money out and just took required minimum distributions. Again, I talk a little bit about that, but the government makes you take required minimum distributions out of any account that you have not paid tax on. So if you have an IRA, 401k, 403b, 457, all those type accounts, you need to pay money, or you need to take money out, and you'll have to pay taxes on them. All right. As you can see here, they're writing checks for up to $300,000. As they got older, they're writing checks for $400,000. This is checks. This isn't the amount that they're getting out of their investment accounts. This is how much they are writing checks to the government. So you say, okay, we know that you're going to have substantial tax penalties. And really how this works, and I'm working on a workshop, or working on just a video that talks about this. It's going to get more specific, but essentially you're being forced up into the tax bands. This is why this is so detrimental. All things being equal, if you pay 30% in taxes during your retirement and you never go up in tax bands, it doesn't hurt you or help you to do Roth conversions. All right, I could show you numerically how that works. Where it hurts you is if you are being forced up in the tax brackets when you don't want to be forced up into the tax brackets. So if you have to go from 12% to 25% to 35%, it's forcing you up, and you're also having to collect more money. So this is why it's so detrimental. And again, this is just a quick example. I don't know if it's right for you, but we plug in numbers and it gives us a statement that says, well, you know what? If you did Roth conversion, you'd save $100,000 or $200,000 or $500,000. So in this case, it gives you a little chart. It says, okay, you are paying more in taxes here over the next couple of years out to 2032. So you are paying more. You're kind of advancing the taxes on if you did this strategy. You say, but by doing so, all of the green is how much money you would save down the road. Say, well, how much is this? So we pull it up, and your estimated savings by doing a Roth conversion for this example is roughly $1 million. $1 million in savings. Ask yourself, would you like to not pay $1 million in taxes on your lifetime? Hopefully you said yes. So $1 million. Now, this example for you, it might be $200,000. And when it gets down into $50,000 or $60,000, does it make sense for that? Maybe not. It does require you opening up accounts. You got to move money around. You got to pay more taxes. But certainly, if you could save even $200,000 or more, wouldn't it be worth it? I think it's at least worth a shot to look at that and see if it's worth it. So here's some of the results. So this illustration just says, hey, you're going to save about $1 million in taxes. It's going to increase your tax-free net worth over $2 million. Why is this important? Tax-free net worth. Say, okay, well, if I'm just going to give the money away, why do I care? This is for estate planning purposes. So this isn't an estate planning class today, but certainly if you are thinking, hey, you know what, I'm going to give away several $1,000,000 when you pass away, would you want your beneficiaries to have to pay the tax on it? Some people say, yeah, I don't really care. Or in this case, this couple said, you know what, I think what we'll do is we'll pay the taxes for our kids out of our money. And that way they get a full $2 million in benefit when we pass away, or charity, depending on how you set these things up. It could be for charities, beneficiaries, kids, grandkids, however you want to do it. Inheritance and charity giving, they ended up with $4 million that they could give away. Two of it would be tax-free. The other $2 million that would still be taxable. All right. So now if you had two choices, you could do first option. You download the workbook. Again, everybody's going to get the workbook. maxhoursocialsecurity.com. Again, if you got it on your phone, you can just click on it. You'll see how to download it. Or you can schedule a time for our team to go ahead and do the heavy lifting for you. And they're going to give you all the strategies. It's about a 30-page workbook. You just give us the basics. It's about a 30-page report. And I could say that, these are some of the things that you're going to get if you get the report from us. It's going to give you your charts on desired incomes, how much income it's going to be if you do file early, if you file late, if one of you files early, one of you files late, it's going to have all the reports for that. Also, everybody wants to know if break even, right? If you filed today or you started taking Social Security today and you waited to age 70, where's the break even? And it's different for everybody. So general rule of thumb is 80 years old, but you can see in this case, it's better to go ahead and wait. The break even there is age 77 roughly. So if you make it to 78, it would have been better off for you to wait. All right. So you'll get Social Security analysis, you get the workbook, the Roth recovery strategy, if it is something that is of interest to you. And you can schedule that meeting through when you download a Max Hour, socialsecurity.com. When you go to that website, you're going to fill out a form. That basically is a form that says, where do you want your workbook? We're going to send it to you as a PDF. Just easily tell us, your name, phone number, email. You got to put in your right email. I just had somebody the other day. It's like, I'm not getting it. I go, well, what's your email? I go, I don't want to tell you. Well, it automatically downloads it, or I have to send it to you via email. So if you don't want to put in your right email, you won't end up getting it. And then if you click on this, I'm sorry, do you want your free Social Security exam or analysis? You just click on yes and hit submit. It's just that simple. If you don't want to get your Social Security analysis done by us, just click no. It's okay. We have done hundreds of these, so I'm not offended. Go ahead and get your workbook if you want to do it on your own. And so we have just a few minutes. I did talk a little bit long. I like to end right at 8 o'clock and be respectful to everybody's time. All right, so let me go ahead and take one of the questions. Let me go ahead and pull it up. On the Q&A. Okay, so John wanted to know if he's been divorced, if he could file. He's only been divorced 5 years. So John, no, you have to be divorced for, you have to be married for 10 years, and then you have to be divorced for 2 before you can file spousal benefits. So no, you would not qualify for spousal benefits in that instance. All right. All right, let me pull up another one. The year, okay. Susan asked, the year that you retire, is the $25,000 limit in force? The answer is no. Actually, it goes up to 50 some $1,000 the year that you retire. It's a higher benefit, and they take $1 back for every 3 that you earn over the limit. I didn't have that here in the presentation. If that's something you want to see, let me know. I'm more than happy to show you. But it is a substantially higher limit. So you may want to wait, depending on your income level, you may want to wait until January or so of the following year in order to start your Social Security and get your benefit that way. All right. I had a question in here about disability. I don't get into disability insurance for Social Security. You'll have to call Social Security Administration. I don't know the ins and outs of that. I apologize, but I can't help you with that particular question. Again, call Social Security. They may be able to help you get increased benefits. All right, so a couple other questions, but I think they're generally focused on working. Again, you can work if you're going to make more than $40,000 a year. You do not want to go ahead and file. You want to wait until your full retirement age, because they're going to claw most of that back. You won't get your increases, your 8% increases. It doesn't really benefit you. If you're going to pay it all back, what's the benefit of getting Social Security? You just stuck yourself with a lower payment for the rest of your life. All right, so I do appreciate everybody being on this call. Every once in a while we have estate planning. The next one coming up will be an estate planning. Because you attended this one, you do get invitations out to the other workshops I do. Whether it's again, you already did the Social Security, but income planning, lifetime income, Medicare planning. What's the difference between traditional Medicare and some of the other Medicare plans? HMO style versus traditional, and all these other retirement focused webinars that I do. You just stay tuned. I'll send those out if you're interested in it. Remember, you can always sign up for it and watch the replay afterwards. I do always send out the replay to everybody that's signed up for it, so you don't necessarily have to be on the call. I like it if you're on the call because I get to answer your questions, but if you can't make it to the call, no problem. We will send out the broadcast to you. All right, so I do appreciate everybody being on the call. Hopefully this was a good workbook or workshop for you regarding Social Security and Roth conversions. Again, thanks again for tuning in, and we'll see you on another call.